Tuesday, April 14th, and the world is refocused on the US, Iran, the Strait of Hormuz, and you can find a million perspectives on that. So like last show, I'm looking elsewhere for content, useful content. And like the last show that focused on the fear that AI is going to drastically raise unemployment, this show, I want to focus on the fear of artificial intelligence on the software industry and businesses, the SaaS-pocalypse, SaaS, software as a service apocalypse. And so let's talk about software. The IGV on your stock ticker, put in IGV, that's the ETF, exchange traded fund for the software sector, and it is getting hammered this year. The first quarter, compared to the S&P 500 in the first quarter, it is having its worst relative performance ever. Software's lost a quarter of its value year to date, over $1 trillion, and it's down over a third since October. The growth forecast for the software sector is last year, it was 15% growth. This year, 5%. So it is being sold hard right now. So look, it's important to be realistic and emphasize the risk because you know that I prefer to do that and be prepared for the worst. So just like employment from the last show, there's going to be an effect and there will be casualties. But the SaaS-pocalypse fear, the panic, is based on the first order analysis that the terminal value of the software subscription revenue model is going to be cannibalized, and the thinking being that if AI does the work of 10 humans, why should I pay for 10 human seats? Instead, I think it's important to differentiate substitution versus productivity. Not that we're going to substitute AI for humans, but instead look at the overall productivity that this can lead to. And so that would be, of course, going along with what the industry is experiencing now. And that is a change from seat-based fees to aggregate usage, overall usage of the artificial intelligence, of the AI. And so last weekend, there was a conference, HumanX conference was the name of it, in San Francisco. And they met, leaders from all sorts of tech companies met to discuss the latest in AI technologies and applications. And I looked through lots of transcripts and found a couple of interesting things. The president of an AI startup called Decagon said that a project that required in the past 4 or 5 engineers now becomes 2 engineers because everyone can move a lot faster and farther. So the faster and farther part are what I'm focusing on there. And then let's look at what Jeetu Patel said, the president of Cisco, who manages 18,000 software engineers. He said that you can't think of these as tools, AI as tools. You have to think of them as digital coworkers joining your team. You may have a team of 2 people and 6 agents. You might have 2 people and an infinite number of agents. On and on and on. But the commonality of these interviews, of all these C-suite executives, was that people are needed. People are still needed. And more than that, they focused on the productivity and specifically the speed of AI adoption. And that was their paramount concern, was the speed and effectiveness of the adoption. So Wall Street, like I said, is selling off software on the worry that of the human labor substitution, that humans will be replaced. And it's, in my opinion, missing the employment retention, okay, the ones that are kept continuing to work, plus their increased productivity. So again, productivity in aggregate. And so this is not a story about firing people. Yes, there is slowing in the hiring, but the people that are there are holding their positions and implementing AI, and their productivity is crazy. It's going through the roof. So the young workers, the graduates, that please see the last show. If you're concerned about being a young worker looking to get in or being a new graduate, please see the last show because I addressed all of that. But back to what we were talking about, what matters most is the data. That is the gold behind all of this. And there's no substitute for that data, for the experience and the sheer volume of user data that these legacy companies have. So the higher probability risk is to the simple application layers, the user interfaces that can easily be replaced by artificial intelligence. But the much lower risk is to the companies with the full system, the full stack, and that are the systems of records. They've got an incredible moat to change because of all of that data and all of that experience, user experience. And I was thinking about the logistics. As you know, I used to do network engineering, and the logistics of the compliance and the insurance risk. Think about the legal system. Think about healthcare. And I really think that there's no chief information officer out there that will risk their job to implement vibe coding in real time. It's too great of a risk. And even the AI companies themselves, the actual AI companies are outsourcing their internal networking and logistics because there's too much happening too fast and they have to keep up. And so the race against competition means that there's zero tolerance for error, and the premium is on speed right now. So as we all know, they're going at breakneck speed to keep up. They can't afford to experiment and change the systems that they've got. It's cheaper, and it is, in my opinion, more importantly, to manage their risk and their liability by even outsourcing this. Again, the AI companies themselves. So the last thing I want to say is remember what we were talking about with Jevon's paradox, which is that as technology becomes ubiquitous, the price comes down, which means that there's more widespread adoption, and the cheaper it gets, the more it's used, and then the larger the addressable market, and overall there's an increase overall, even as the price comes down. So net revenue goes up. So in a nutshell, that's Jevon's paradox. And when you take that and you combine that with the new, not the seat-based model, but just the overall usage-based models, that gives true value to the software systems. And so I'm searching for, or what's always on my mind and my watch list are companies that are vertically full stack, vertically integrated systems of record that control much or all of the workflow, and they've got that legacy data that cannot be replicated, and the experience, the data, all of that, and they control the full stack. And so the last statistic I want to leave you with is that companies who are successfully adopting AI for internal engineering, all companies, AI and otherwise, that are adopting it for just their internal engineering, are reporting that their cash flow margins are expanding at 2 times the global average. So that is today. Those companies cannot afford to experiment and lose time, and this is a race against speed, as we all know, with the incredible CapEx spending, et cetera, et cetera. So there we go for today. I hope that's useful. I hope it maybe allays a few fears about the software industry. Yes, there will be losers, but again, those application layer companies that just do one thing, one user interface, sure, there's going to be carnage there perhaps, or just replacement, but but look to those legacy full stack companies with all that great data, and we'll see where it all goes in the future, but just some food for thought for now. Thanks as always for joining me. I appreciate you. Bye-bye.